Ours.
It's gonna be good, dude.
All right, fellas, I've pressed the button.
I see. It says we're streaming live.
Streaming live.
Yeah.
It gives. I don't know if it buffers or what it does, but it's
on. You just don't know.
Yes, it is. Every time you think that it's not going, but it is.
So, welcome to Value After Hours, a four-way session. I'm one of your four hosts, Bill Brewster, joined by my esteemed colleagues, Tobias Carlisle, Jake Taylor, and Michael Mitchell. Gentlemen, how we doing today?
Living the dream. Living the dream.
You like how I threw back that intro?
Nice.
We used to do that.
It's tight.
That's nice.
But what time is it in around the world, Bill?
That I don't know, but I do remember our old intro music.
It still plays in the audio version. It still gets a nice little intro. I could probably find out how to do it through this thing too, as like the holding, but
too much work.
Too much work. Too hard. As much as I love that music. What's
I
happening,
get
fellas?
like legit intro music. Why don't you pony up for that, like 2 Chainz or something? So when we come on, it'll be like, y'all.
I like the
multiple y'all.
The Grace Misa one. I like the how we do.
Yeah, that was the outro, wasn't it?
It's both. It's for all. It's different versions of it, different little riffs.
Yeah, that shit was hot.
I think we need to get Toby on the piano and he'll remix that.
There you go.
And then we'll have something cooking.
Toby on the piano, Jake on the guitar, Bill on vocals, and I'll take the
percussion.
Percussion.
More cowbell.
Tambourine by Mike Mitchell.
Anything interesting happening in this market, gents? We were just saying before we went live, it's a little bit quiet at the moment. Never short a quiet market. Quiet before the storm. What do you think? What's happening?
I don't see storm clouds on the horizon.
Even from you, Hurricane Bill?
No, but I do like that Bill is getting stronger. That makes I take energy from that.
Also said it was short-lived though, so I don't know.
That would be unfortunate. I don't know. Mike and I talked yesterday about using SPACs as like cash substitutes and what your risks are. I think that there's some probably interesting things to look at there. I don't know. I think same as always.
Where are the SPACs?
Some cheap stuff, some expensive stuff.
Yeah.
Have the SPACs come back to cash, or are there some SPACs back at cash? Cash back.
There's some SPACs around trust. Yeah, there's some. There's not a lot. I mean, SPACs have rebounded. Like the names, like I haven't seen them today, but last week they had a pretty good week, and Chama's back in the green on a lot of these things. So they've had a nice rebound, but I don't think it's crazy to use them as a cash alternative. But they will correlate to equities in a liquidity crunch. But outside of liquidity crunch, that's what I spent all last week. We were talking about that, Bill and Toby. What could derail the market? What could derail the economy? I spent all weekend, I'm just back and forth in my brain, what could do it? And I finally, Sunday night, I just tweeted out, I was like, I'm just incredibly bullish. And I didn't arrive at bullishness. I arrived at like, I can't figure out why this isn't going to work. Like somebody.
Via negativa.
Please. Yeah, it really was just the lack of like, okay, keep just subtracting and subtracting and subtracting and subtracting. And just sort of left with everything at the bottom looks pretty good for now. I mean, that's just pretty good. I mean, these valuations, like if you think the 10-year stays at 1.4, like you can pay anything. I mean, anything. 50 times earnings is cheap.
Here's the thing, though. If you use that Hussman method of assuming mean reversion in the Shiller P back to the long run average, which is 16 point something, so that may be that. There's the assumption that we can all argue about, but assuming that you do that, the valuation that you come to, or the expected return on the market is now 0.7% total return, which includes a 1.4% dividend. So that's 0.7%
juicy
negative on the index for the next decade.
Bullish.
To get back to that. So, is that assumption legitimate or not? I don't know, but it's been pretty over the very long cycle. It has been reasonably predictive. And where it diverges is exactly at these points, like market peaks and troughs. I mean, that's presupposing that we're at a peak, right? But that may be the indicator.
I would argue the assumption pretty heavily.
Yeah, I'd say we're definitely closer to the peak than the trough. I mean, that's, are we there or not? We're definitely on that side of it. I mean, What inning are we in, Bill? Or did we
Inning.
change innings in the last week?
No, I don't know. I still think the starter's getting a little tired. We haven't
Yeah.
gone backwards, I don't think. But I don't know.
The biggest,
I think
the
you could
biggest-
have a scenario where the economy rips and the market doesn't do well. But like, I don't know with this much money out there. I just have a hard time buying that rates go up. If interest rates are the price of money and there's a huge supply of money looking for a small minority of good ideas, the idea that prices come down like fundamentally doesn't make sense to me.
What about inflation? Like inflation, I didn't look at this. I heard someone say the expectations are at 5%. Is that insane? Am I way off base there?
I don't know.
No, I think that's right. I think that's the actual number. I just think the question is, the debate isn't whether it's 5. The debate is that 5 going to stay 5, or is it going to go back to 2, or is it going to go to 1, or what's the next?
But even at 2, if the 10 year is 1, if the 10 years at 1.4, then you're negative 0.6 real. Like, how sustainable is that?
You're starting to sound like Kyle Bass. Yeah, don't worry about it. Kyle Bass said, I think today he said real rates are negative 10%. So he said you're like inflation. Yeah, inflation is like 12 or something, and your real is 10.
Is
So
that
what do you
like
do?
using
You
the
sit
shadow
in
stats?
cash?
Well, no, you
Just
can't
watch
sit
your
in
cash.
cash
Worst
get
thing you-
torched.
Nickels, all nickels.
Doge.
Yeah. So I don't know. What do you do?
SPACs at
nickels.
cash backing. SPACs at cash backing is not a bad idea, right? Because you might get some mark to market issues in a liquidity crisis, but at least the cash is there. It'll come back to you at some point.
I mean,
And then
you
you've
know
got
the
some
answer.
upside.
The answer. This is gonna make Jake. He's gonna love this answer. The answer is buy the shit out of levered equities.
Yeah.
No.
It is because your debt is
Inflate the
cheaper.
debt away. Yeah, inflate the debt away. It's not
So
crazy.
that may make you upset, but it's not wrong.
I get it.
Well, that does work. that works. Like if we go into an inflationary environment, you get all the, you get like the cyclicals that are highly levered. Like that's the stuff that's going to go bananas.
Mhm.
Well, especially if it's
Or like
low
cable companies.
replacement capex. Like if you don't have to pay with new expensive money
Right.
for the capex, and you pay back with this, cheap.
Capital intensity cut you. Yeah, especially if it's truly maintenance and it's not growth, it really starts to cut you. The problem I have with the whole thing is there isn't, so everybody wants the prediction, right? And it obviously wants to be right. But the problem I have with the whole thing is I've never seen a post-pandemic playbook for the US consumer. I've never seen one. If somebody has one, please send it my way. I'd love to take a read, but I don't, it's all like, I'm not sure the guesses of anybody, myself included, are any better than anybody else's guesses, because we're really in this kind of funky spot of like, people were cooped up for a year, people didn't pay rent. And it's like, and for a time, I'm not speaking for the world here, just myself, but for a time I was like, this could get really bad. And so there was this whole and when liquidity was drying up in the markets, I thought for my health, it could get bad, but then also the markets, it could get bad and liquidity could go to zero. And I feel like I sort of dodged a bullet, and so now I'm kind of like, hey, really YOLO, not on stocks, but on I want to go to a nice restaurant. I bought a new minivan, I want it not recently, but last year. There's this feeling that you want to, and I don't know if that feeling sticks around for 12 months or 24 months or 5 years. I have no idea. I mean, I felt there were some permanent changes post September 11th. And I just sort of wonder if that's the kind of thing that we're looking at here, that we get this economic growth and there's some permanent changes, but in general, I think the real challenge is nobody's seen anything like
What were the permanent changes after 9/11? Because I feel like 9/11 is the last event that was on this kind of scale.
Well, we all travel different, right? It's post 9/11.
Yeah.
I mean, the traveling is just,
It took a couple of years to bounce back, right? And then it was back to normal.
Well, but then structurally, I mean, we all structurally just travel different. I mean, it just takes longer. It's just traveling is much less convenient than it was in 1998.
You fly private, don't you, Mike?
Now we have to wear a mask and take our shoes off.
It's funny. Yeah, exactly. It's funny you say that, Toby. So the only thing I can't do in the world that I want to do, I would love to fly private. I can't do it. I can't afford to do it. But even if I could afford to do it, my wife wouldn't let me do it. She's has socialist tendencies, and she really believes in the environment. It's like the worst thing you can do for the environment is fly. It's so terrible. So, and she doesn't want our kids to think that that's even a thing. So
get her on a plane and see what she says.
I know she's never been on one. So my job at two hedge funds.
Just don't go on one. You'll be fine.
I know if you never go. My old boss only traveled private. So every time we go to a board meeting, it'd be on like a a G550, it's like the dumbest thing. 3 guys, and by the way, half those trips I shouldn't have gone on, but they have to justify, the $40,000 and $10,000 an hour trip by putting analysts on there. So I'd fly on it. And I have to tell you, it's quite nice. It's really a different, when like you just drive right up and the pilot grabs your bag and puts it on for you, and then you sit there and you like do anything you want, and then pretty soon it is different. But I'm not taking my wife on a private plane. She still won't let us fly on a private plane. That's the one thing I can't do. Everything else, I can get any minivan in the world I want, but I can't fly private.
I think that's the only thing that I would really risk a lot for, is to be able to level up to fly private.
It's nice.
Like if Curate Part 2 comes around and we're on the phone and you're like, hit this thing hard. Yeah, it would probably need to be like private would be the next level up.
So Toby,
probably buy some calls.
What you want.
YOLO call, so you can get the Uber Premium NetJets membership.
At least enough calls that you could level up your life, but not so many that you would level down your life. That would maybe be how I would think about that. I don't know.
It was so dumb on Curate. I was writing those puts feeling like a hero, and it worked out quite well. It was the stupidest move. I should have bought the calls. Like,
dude,
you had the trade. What are you doing?
No. Wait,
what are you doing?
Will you talk about why you did that?
Wrote the puts?
Because I think that's an interesting insight that you had into option pricing.
Yeah,
when we were talking about it.
So, for me with options, I view options, especially like short-term options, as being priced perfectly efficiently mathematically, and it's priced based on historical volatility. And so when I look at options, and I almost never buy them and I almost never sell them. When I look at them, I think I'm going to mispronounce his name, but Ben Pfeiffer, his name. I just, in my mind, I assume that when I'm buying or selling an option, I'm buying or selling it to or from him. And he's a lot smarter than I am. And that's his entire job, right? So I only venture when I think that there's a chance that I know something that Ben doesn't know, right? And so it's something in the business or in the world or in the security changes and structurally changes what you think the future pricing of that option is going to be. And so the models that price options, the computers that trade those, trade them perfectly based on historical information. But if the future is going to look very different, by the way, that's just lifted from Greenblatt. That's not me. I mean, that's like directly from the pages of You Can Be a Stock Market Genius. So for Curate and for these spins and special dividends, so the options price based on the value of the equity. If the value of the equity is going to be returned to you in cash, if it's going to be given to you in a different security, like a security in a different type of a business, then that you can. So what I saw specifically in Curate is it was a $10 common before this entire event happened. I could write a put that struck at $10 for $2.35. So think of it as a 23% premium, and it was about 18 months of duration. So forgetting whether that was a good price, 23% for 18 months was a good price or a bad price, forgetting that for a second, what I knew was if you just waited like a month, they were going to send back $4 of your, what was it, $4.50 bill? The $3 preferred and $1.50 in cash. Yeah. So in my mind, I was like, well, I'm not insuring $10 of equity here. I'm insuring like $5.50 of equity. So now you're paying me $2.35 to insure $5.50 in equity that I feel pretty good about. That's 2 times earnings. And by the way, you give me that premium, and then the thing does, crater. It's like I basically am buying stock at 1 times earnings. Is that a good price? I was like, well, that makes sense to me to do that. And so, and then I also had the view, as you shared, that there was a good chance more capital could be coming back. So, and sure enough, that's exactly what happened. So instead of insuring 10, which is how the options market was pricing it, I was insuring immediately after this event $5.50 in equity value, and then we got another $1.50. So actually now that puts only insuring $4 of equity value, and it's a $22.35 premium. So it's like a 60% interest rate to insure that for 18 months. It just seemed like that was probably mispriced. And then now, of course, because the equity went up, that's basically a worthless security. So it was that was a nice payday. I wrote that, I think 40,000 times, something like that. It ended up being pretty good. It worked out. Was that too much? Should I not disclose that information?
No, so in that scenario, you're trying to clip out the vol rather than like buying it. You didn't want to pay the vol on it.
Yeah, that I probably could have. I mean, if I would go back and like do a now postmortem, I think the conclusion I would have come to is like, if you really believe it, you have to understand too. I 45% of my invested assets in the common as well. So if you added in the puts, if they got exercised, even after if you added the puts in after all the distributions, my exposure to the common would have still been like 35% of my book. And the problem is it's 35% if it doesn't work, right? So it's like the worst case. So psychologically, it kind of messed with my head. But I think if I did my postmortem and went through this again, I think the conclusion I would have come to is like, you're an idiot. If you really believe in this, don't put your exposure on the put your exposure on the call and just burn the premium. And if it works, then you're going to get the distributions. You get access to those distributions through the call, because the calls adjust, all the options adjust when the distributions are big enough. So you get exposure to that, and then of course you can get leverage, on the ups, instead of thinking that the puts were mispriced. And I can tell you the puts were wildly mispriced. It's very rare that happens, but they were wildly mispriced. I think they probably should have been 50 cents, 40 cents, and they were trading for 235. So it seemed like a pretty good short. That was basically my only real short last year. And it ended up working out pretty well. But I think the answer would have been to buy the calls rather than the puts. But you can find those when you see these spends and splits. Actually with AT&T Disca, that's, if you were going to do something, that's probably the play, is play it through the options. I mean, you could buy leaps on T for like nothing. That was something I was looking at. I haven't done anything with it, but those options on big events can be wildly mispriced. I mean, wildly mispriced. I think options in general are not mispriced. I think you have people like Ben who figure that out really quick and they can take advantage of those mispricings. But if there's a big change in the underlying business, or like in Curate, there wasn't a change in the business, there was just this huge change in how the equity was constructed, which, by the way, I tweeted this out last week. Shout out to Liberty. I mean, that's fucking unbelievable what they did. I mean, those preferreds are trading for 16 and a half times earnings right now, 16 and a half times cash flow, and the common's still at like 4. It's just that worked.
Where are they trading? Like 110?
They're at 110. The yield to redemption, and this is the 10-year out redemption, I'm assuming, not the 5-year redemption option. You go out to the 10-year option, I think it's like 6.1. So it's about 6.1 yield to worst. If you just invert that into a multiple, it's probably close to 17 times now.
Dude, you know what's crazy? Those traded down to 88, and the common traded down to like 588.
You want to know what's worse? Let's talk about our L's. So I sold them at 91. The ones I got.
I remember when you did that.
Yeah, because but it was taxes, right?
Doesn't matter very much.
Yeah,
I do remember when you did that.
So my basis in those was allocated at like 117 or something. They add the basis out, like, or maybe 107. So I had this big short-term loss in them. I was like, awesome, I need short-term losses. So I sold them, and they like literally the second that my sale cleared, they went to like 98 or something like that. And I was smart enough, I bought them all back and more.
You know who called that right is Sir Baby 6. He was like,
oh yeah, Sir Baby.
When those prefs went down, he was like, this is the bet. I never saw the juice in the prefs. That was the problem for me.
Well, to be honest, the bet was actually just to take all your proceeds from the prep and put it in the common. I mean, it was a 4-bagger from the bottom, or 3-bagger from the bottom, I think now. So that actually was the common is the place to be, but the prefs were, if you were just looking for safety and yield, the prefs were great. I'm a little pissed that the prefs are now 110 because I was using them as a cash proxy, and at 110, I'm no longer using them as a cash proxy, but they're a nice security. So anyway, that's put writing. It should have been call buying. It's put writing. It worked.
Call buying is a little more risky though in that situation.
Yeah. Well,
it just depends on the scenario, right?
Yeah, like it depends on what happens.
If there's a lot of vol in the stock, I like writing puts when there's something that I know really well, and there's some little crisis, something falls over, and then you write them, get a little bit cheaper than you would otherwise get them. Maybe they're not exactly where you want to buy them. And I like calls or leaps where the market hasn't done anything for a long time, and it's in a very good stock that keeps on. The underlying business is compounding away. It's just that it got expensive 10 years ago, and it's just done nothing. So there's no vol in the stock at all. It's completely quiet. Nobody wants to buy the options, and you buy the leaps with 2 years out where it's kind of getting to that point where it's getting silly cheap. And then you get the big moves I've found from those.
All right. So let me throw this one at you. The homie Bluth Capital, we went to dinner a couple nights ago, and he threw this one out. Ford, super low implied volatility, working on an EV that could be pretty damn impressive. What happens if Ford turns into an EV stock and you own some low vol calls?
That would work.
I don't know.
It might work.
Right? I don't know. That's kind of one of those scenarios. He was just like, I'm not saying that, it's like this slam dunk trade, but it's one of those that like stock starts going up and your vol could go up too. That's a pretty nice combination in options world.
Yeah. Are you guys
I own
tempted
none.
to play
I will own
AMC?
none. I'm just saying.
You're not tempted to play AMC? It's that all the vols in there
dude.
right now.
I got my face
I'm
ripped
joking,
off
Dave.
I got ripped off in Tesla. That was the highest vol
Which
thing
way?
that just like last year or 2 years ago.
What were you trying to do in it?
Oh, I was just trying to fuck around and like skim premium. Like selling spreads at the wrong time. And because I can't get myself to buy the options when there's that much vol, because I'm just like convinced that vol crush is going to screw me. So then my brain, rather than saying, well, this is too hard, because it's like my retirement account and I treat it like a dog that I hate. I'm just like, well, I'll just sell the options. Who cares? Right. Well, turns out that hurt my returns in that account.
The best book to read about this, because I saw the question come through, is just read Greenblatt's yellow book. You Can Be a Stock Market Genius, or How to Be a Stock Market Genius, whatever it is.
If you really want to nerd out, you could read.
There we go.
You could read like Natenberg on options volatility and pricing, but don't do that. There's better places to spend your time.
The yellow book.
I see those questions that like Ben is like, does it? Yeah. I see those questions Ben will post. I'm like, hey, you want to be a junior analyst in my firm? Here's a interview question that you ask. And every single one of those, I'm like, I have no fucking idea what you're even talking about in this question. Like, if you gave me that, I would be like, can I make you a coffee? I can't, I don't know how to answer that question. So I just stick to the one for stupid people.
Yeah.
It gets you most of what you need.
Yeah, that's a good book.
You don't need to know the option value mechanics so much as you need to know what happens if the underlying moves in the direction that you think it could move in a material way that is not accounted for in the option, in the normal distribution of the option pricing that's used to calculate the current price.
Said perfectly.
And to the beginners out there, you also got to know how much volatility is in the option, because it is easy to pick the right strike and still lose money, or theoretically, right? The right strike you wouldn't lose money in, but if you lose a lot of volatility out of your option, you can be right on the direction and still lose money, is what I'm trying to say.
Mm-hmm.
So I don't know how all these Robinhood kids are doing this stuff. Like stocks are hard. Options like next level shit.
Well, everything's been going up.
Yeah.
So you buy the calls and everything goes up, and like it gets to this point in the market where I left long ago. JT probably left before I did. There's not many other, all the value guys are kind of gone. And then the only people left are fearless, like kind of dancing on the edge of the cliff. And if you buy at that point and it keeps on going up from there, then you make a lot of money because there's no one there to kind of push the options back into line. Like the skew's massive.
We need a theory about this, something about how I buy and then I expect to like find somebody dumber than me to buy it from me. We need one of those. Is there a theory that explains this? I don't know. There's
Still working on it.
Yeah.
I still think these compounders that are like 3 to 5% free cash flow yields can really work here.
That's like the FANG type names.
Yeah, and I mean
Fangy.
Yeah, I mean, I don't own it, but I can see why people own TransDime. I can see why people own. I mean, I do own Disney. I think Disney is not like easy to swallow valuation wise to me, but I see why. Like, I know why I own it. I mean, this Universal Music Group asset is a really interesting asset. There's some of these things that I just think can work. It's got to be high return on capital. You got to have massive reinvestment runways, and you got to be right. So
margins.
That's it. Figure those out and let us know.
Layup. No problem.
I think there are quite a few of those around in the market. I think they're
like Fastenal. I haven't looked where Fastenal trades. I bet Fastenal's is fine from here
if they can reinvest.
Because those assets just haven't gotten the bid. You know what I mean? Like, they're not like the crazy bid assets. They're more like, if rates go up, you're kind of screwed. But if you're playing a wealth preservation game, I understand betting on that.
As there's money everywhere, like everywhere. I was just, as you're remarking this, I'm thinking in my mind, I'm like, UMG is like 20 times EBITDA. I'm like, why would you pay 20 times? I mean, why would you pay that? And the answer is, well, interest rates are 1.4, which is why you can pay 20 times. But it got me thinking that there is just, this is part of that other conversation about what could derail it. And I guess interest rates is the only answer. There is money everywhere. My business partner is going out to buy private assets and coatings and restaurants, and the bids are insane. Like, you think, housing is insane, and it is. You get these offers at or above ask in a lot of cases, and we hear all these anecdotes. But private business is the same thing. Shows up to buy assets that he's qualified for, has the money for, offers a good price, and is like, sorry, dude, there was like 8 bids over offer for this restaurant franchise group he was bidding to buy in Dallas.
Yeah, bidding at the offer, that's an insult.
Yeah,
that's an insult.
Seriously, in all seriousness, I mean, it's there's just so much money out there. It blows me away. So you're probably right on UMG. I'm like, in my mind, I'm like, it's 20 times EBITDA, but the answer is probably, why wouldn't it go to 25? Like, why not? Go to 30.
Yeah, well, double-digit growth for a long time and high returns on capital can work.
There's a lot of ways to win. There's a lot of ways to win.
My mom is in Scottsdale, realtor. Shout out to her. The stories she tells me are insane right now with the housing. Like she is going around door knocking on behalf of clients and then hoping that somebody hasn't already done it. Like that's crazy. There is no inventory out there.
Yeah, that's the problem. I have this belief that it's my hope. Please, home builders, do it. But I have this belief that home builders like to build. So my guess is that they start building again. It solves this inventory problem. But in housing right now, inventory is a very real problem. There's just not a lot of inventory. I mean, you're seeing it in pricing, and you're seeing builders defer starts. So my hope is that changes. But I feel bad for your mom. I mean, there's just nothing. It's realtors are losing on that, right? Because if there's no inventory, there's no transactions, and guys who do contractors who do repair and remodel, those guys, their business is down. My guy, I posted this on Twitter today. I can get him on a Spaces. He's a really nice guy, but he's only Northern Colorado. And so I asked him about business. I mean, it's like, you must be slaying it. He's like, no, you don't understand. There is 1/3 of the normal inventory at this point in the year that we would expect to see. And so my call volume, people only call me when they buy a house that the existing home they want to move into and they want to remodel. He's like, my calls are down 60%, 70%. Nobody's calling because there's no houses for sale. He's like, oh, on the one hand, you start building new homes, then you'll get move out, move up. And so he thinks that existing will start to turn. He's like, the demand is there, but when homes don't transact, people just don't remodel. So
why are they not transacting? Because it's still, everybody's still under COVID restrictions.
There's not, so we don't have enough homes in the country. So Bill, you look like you're about to jump in. You can jump in anytime, but we don't have enough homes.
I'll tell you exactly what happened with us. I had a realtor that called me. She gave me an unsolicited offer on the plot of land that we bought that was 70% higher than we bought it in October. And I said to her, I was like, okay, like I respect that you're trying to make a transaction happen. So here's how you can make that transaction happen. Bring me another plot of land that I'll be happy with, that I can actually afford. So because the problem with this, and she didn't like how I said this, but I did, and it's the truth, is I was like, you're the only one that makes out okay on this, because you're going to make 6% on the transaction on the front and back end, and I'm the one that's going to lose 6% of the equity value of, the total transaction size, and the size is higher. Like, I simply don't want to pay that much just to make a transaction happen. So if you can get creative, I'm down to do it, but I'm not just going to do it.
Yeah, that's the problem. I mean, you sell your house, where you sell your land. Now, where are you going to build? Like, that's why homes aren't moving. Existing homes aren't moving, is because where are they going to move to, right? It's like, my wife wouldn't let me sell our home in Fort Collins unless I presented her with another home that she liked even more, in which case it'd probably still be a discussion. But there's nothing for sale. I mean, that's the problem. Like, I can't sell our home because I wouldn't have anywhere to move us, and my wife's not going to move into an apartment.
Somebody out there that's asking, well, why don't you rent? The answer is because I try to make my wife happy every day, and she doesn't want to. That's it. That's the answer.
I had lunch with Greenwald last week. Greenwald, Cap, shout out. He's just the nicest guy in the world. He did that. He never did that. He buys homes for a living. He bought a home, lived in it, and then he just sold it, and he's renting now for the first time in his life. So that does happen. He's also not married, doesn't have kids. That's not happening in my house. Doesn't sound like it's happening in the Brewster house.
Yeah, you're not a value investor until you've sold your house and told your pregnant wife you're going to be renting for a little while. That's when you're the real thing.
And you lived in it for 10 years.
Yeah. Then you lose half your shit when she leaves, and you think, value investing.
I made out like a bandit on that one. Good deal. Good trade.
Hey, T, you want to do some veggies just before we run out of time?
Yeah, sure. So this is going to be titled Real Estate Gravity. And it's...
That was good timing. Good segue. Yeah,
right. Maybe it's helpful. I don't know. So in gravity, it's inversely proportional to the distance squared of the sphere or body that is emitting it, right? And I always wondered, I don't know if you guys ever did, but like, why is it squared? Like what's the mathematical relationship that's happening there that we end up with that equation? Maybe I'm the only one who's wondering that, but
some Newtonian physics there.
Well, it's actually kind of
physics.
simple. If I'll try to explain it. So if you imagine that gravity is like spread out around a sphere in like sort of like a light bulb emitting light around it, and as you move further and further out away from it, that same amount of gravity has to be then spread over that an increasing surface area, because the surface area moves up as you make a bigger sphere, right? So let's imagine like a beach ball, and you have a certain amount of paint that you have in a little can, and you have to spread that over the beach ball. Well, at one size, you can get a thickness to it, right? A certain thickness. But as you inflate the beach ball like to 2x, it's actually 4x the amount of surface area now on that beach ball, and you have to spread the same amount of gravity paint around it. So that's why the relationship is what it is. Okay, so it turns out that attractive locations in real estate in the world, mobility, are like large planets. And there's actually this mathematical, like sort of natural law to it that researchers from ETH Zurich, MIT, and Santa Fe Institute found. And they used anonymized, aggregated mobility data from cities all around the globe. And what they found was that there's a law that governs like basically like how the number of visitors to any location, and it's related to how far they're traveling and how often they visit that location. So it's kind of intuitive. Like people visit places more frequently when it's a shorter distance, and it just so happens that it follows that same natural law of gravity, where it's a square of it's the inverse of the square. And so if you can imagine why this is helpful, is that it gives sort of a baseline in cities where you can see certain areas are under or overperforming what would be expected based on the distance and the number of travelers that are moving around. And so it can also really probably help city planners to figure out like, okay, where do we put certain amenities? How should we set up public space, parks, things like that? And then also it can form public transit. So, my favorite thing is when you can find something in the natural world, like something mathematical or physics based, and then find sort of the human analog to it, where the same principles, the same properties hold. And I thought this was kind of an interesting one for real estate people, and maybe a new way of looking at it.
You should trade using Fibonacci sequences. I'm glad that joke went well. I guess, is that controlled for like, I don't fully understand the analogy. I'm sorry, but like, cause I'm just thinking like the amount of visitors, there's such a high density among the coast, right? And like water. Did they like control for certain things? I'm just trying to really understand what you're saying.
I think the research, I didn't see anything that specifically pinpointed like, water or things like that. But I think what they're saying is that there's a baseline of what to expect based on how far away that people are from it and the number of trips that they make. And that can then tell you what the likelihood is of the attractiveness of it. Right.
Okay.
And
so
also,
like, for instance, if you wanted to build like Disney World, you would maybe say, okay, well, these are the surrounding populations and the roads that come in. So probabilistically, this is where you should think about building. Is that what you mean?
Yeah, exactly.
Okay.
Like how many trips do those people take, and how far away are they?
Okay.
Right? And it decays at that same square root proportion as gravity does.
Huh. That's interesting. All right, cool. It clicked. Thank you.
That just made my day.
Can you use it as a value tool? Like, can you say that these things are, this thing's further away from this thing, therefore it should be a valuation sort of relationship should exist between them?
I think maybe idealistically, it might be something that you could infer that this is an underperforming asset relative to the number of visitors that you would expect from a baseline of what the math would tell you. And maybe that there's something that you need to do to, like, it could more easily be fixed potentially.
I wonder if this is kind of why Orlando took off. Because if you just think of like Orlando in a vacuum, I know Disney was there, but like that is like a shitty part of the US to just like pick a city.
Send all of your hate mail to
Again, I'll take
folks.
Central Florida hate mail. I will take and field. I will be happy to debate this.
Funny.
But I wonder, because there's a lot of interstates, like it makes a lot of sense. It's really centrally located and whatnot. I think Orlando's a nice city now. It's just kind of why it's there. I don't understand, but this probably has something to do with it.
Yeah, what's interesting is that it regardless of where in the world, because they had like, London, Japan, Chicago, I think was one of them. Like, so it's sort of just a human phenomena it's not any particular culture.
It's fascinating. People are fascinating. I do these walks every day for an hour. It's just sort of my meditation time. And it's just like time for me to reset my psychology every day because my psychology will get messed up. And by the way, Twitter is like the worst for psychology. It just like messes with your head. And so you're sort of like this hour that I walk. And I was thinking today on my walk, I was like, it's just, people are just funny. And they just, they're in some ways just so predictable. And in other ways, just completely insane. And I love them. They're my people, but people are crazy. So your story,
predictably insane.
Yeah, predictably insane. Yeah, that's a good way to describe it.
Given that there's this sort of there's probably a mania in housing at the moment, right? Is that fair? Or does that just fly in the face of everything we've just said?
No, I think you're right when it comes to like Phoenix. I don't know if you're right all over. Like I think that the supply shortage drives more than maybe you could say is a mania. But if it normalizes and goes down quite a bit, I will not. I don't dispute what you're saying that prices are stiff right now for sure.
But there's a little bit of something going on in the stock market too, right? There's something happening in the stock market. You got to give me that at least. Like I think.
When's the last time? Yeah,
rates, bro.
I do give you that, but I'm just saying, like, when's the last time you didn't think there was something going on in the stock market? Like real talk. Like when's
2014,
the last time
2015,
so,
March 2020.
And secondhand cars explosion in pricing of secondhand cars. Like just about any series that I can think of, everything's taken off. So if you dump a whole lot of money in the economy, it turns out that results in the individual things being valued more highly in the units that have been released into the economy. So you guys, you don't think that there's some reckoning from this at some point?
Can we just talk about, like, real quick, the equity market was pretty smart to sniff that out like a while ago, right? Because ultimately who ends up winning are the owners of those
2010
businesses.
Or when did it sniff that out?
Yeah, it's been right for a long time. I mean, I think underlying earnings growth and the return on, well, we'll see.
The last print we have for earnings is like 1230, I think 1231 for the S&P 500. I was trying to look at it this morning and it's like down 34% from its peak. So clearly the first quarter is going to be some different numbers. We've probably seen a fair bit of recovery there. It's still expensive. Like the reason I talk about Schiller rather than the single year PE is that it's smoothed over a decade.
Yeah.
Yeah. I mean, what are the comps of 2020 and 2021? They're almost trying to throw them away and go back to 2019. I don't know.
But there was that argument for a long time that Schiller didn't work because 2008 sucks so bad.
Right.
I mean, that's the whole point of it. And then it rolled off and they said, now you're going to see it start getting cheaper again. And like, market doesn't look cheap to me.
Really? Huh?
No, not historically cheap. I mean, it's only cheap if you compare it to interest rates. That's the only, frankly, it's the only argument I've heard that makes any sense.
And so the pitch is going to be
though. I got to give like Richard Sosa, he does a podcast and I just listened. There's a guy, I think it's like episode 17. I don't know. The guy pitched Thrive. What I would say, if like you're a young aspiring value investor and you hear us talking like this, that dude called up the company and said, can I get a list of all of the shareholders from your company? The company sent him the list. They were obligated by law. He then called each individual person and said, I know that you may have warrants from the DEX debt that you own, like DEX, like Yellow Pages and DEX. I'd like to buy the warrants off you. people had no idea what they were selling this guy. This guy just vacuumed up warrants that are like not traded. So there's like stuff to do. I guess and like there's always something going on. That's so if you're young and you hear us curmudgeon-y guys saying that the stock market's not cheap, it doesn't mean don't do work. Like Mike changed his life by cold calling Kyle, basically. There's shit to do.
I agree.
But Mike doesn't take. Sorry, JT, go.
I was just gonna say I've probably never been more bottom up than I am right now.
But we've got Mike Mitchell doesn't take any beta risk.
I have market exposure through my wife's 403b. She works for a hospital, so I have market exposure there. But otherwise, I basically only own one stock. And Bill's right. It was just imagine, like, it's just funny how things work. Like, imagine if you didn't answer the phone, or I guess maybe I would have put more money in Curate. Who knows? But yeah, it's funny how things work, man. And Bill's not wrong. If you're young and you're looking, the money, in my opinion, is made when you've got a unique piece of information, right? That doesn't mean like that something about the company, or that like it's not inside information. It's not what I'm saying. That you've got a unique piece of information. So to Bill's example, the guy was cold calling a shareholder list from Sosa's podcast. He had a unique insight, and the unique insight was, I might be able to buy this from somebody who has no idea that they even own it, and I have a view that this could be wildly valuable. My unique insight was that I called Kyle, and I actually thought Kyle knew what he was talking about. I thought he was smart. I thought he was going to make me money. So, and that ended up being a pretty unique insight. You can find things to do. You can find unique insights. And by the way, you don't have to be a professional. I mean, I was retired when I did that. I don't know what this guy from Sosa's podcast did. You don't need the resources. In fact, I would argue that those resources, like the expert networks Bill was talking about, everybody's using those. Like, that's not a unique piece of, like, you're not going to get unique insights from those. You're going to hear what everybody else is hearing, which might be useful, but it's not going to be unique. To Bill's point, you can find things to do. It takes a lot of work and takes a lot of creativity. And
I don't dispute that there's stuff to do. I'm just saying that, and in some ways, I'm talking more to the people who are speculating in AMC or in that sort of stuff. Like,
no, that's crazy. That's crazy.
You're playing the wrong game there. You're playing a game where you're going to get dusted at some point. If you're the kind of kid who's calling up people to buy their warrants on some forgotten deal, like that's quite a high level of sophistication to be sort of doing that sort of thing, and you've figured something out. That's not what I'm talking about.
Yeah, no.
Yeah.
AMC is not so bueno. Yeah,
AMC, if you put a gun to my head and said, do something, I'd try to sell the longest dated out of the money leaps that I could, and they'd be calls, and I'd be covered on it. It'd be some sort of call spread, and I'd sell them, and I'd just try to have a ton of time.
The trade with GameStop, actually, a buddy of mine, BWK Cap, was doing this. He was selling like $3 puts or something, and he was getting like 10%. He was getting 30, 40, 50 cents. And these are like 1 week puts because the ball got so nuts. So he's like, look, they have more cash per share than this. Like 2 weeks out. He was like stripping premium out of writing puts that were, when the stock was like 300, by the way. He was like stripping. People, for some reason, were paying him 30 cents to underwrite like a $3 strike. It expired in like a week or 2 weeks. You can't pull out a ton of money doing that, but you could. I pulled out 20, 30 grand. Like, it's a real number. Moves the needle.
Is that like,
I wonder
buying shark attack insurance or something? Like,
I guess. I mean,
what's the
and you
equivalent?
never know. Like, you never know with like banks and machines, like how they're trying to. It's always like when people would look at Bauposts 13F. It's like that tells you part of the story, but it doesn't tell you the whole story, because what you're seeing on the 13F may be a hedge, it may be a macro bet. He may have 15 different derivatives around it that you just don't see. He may have some international longs or shorts against it. Whoever was selling those puts, whoever was buying those puts from my buddy BWK who's selling them, they may have just had it may have been some weird hedging thing that I just don't understand. But just sitting back as a fundamental guy, I'm like, dude, I think after they had like $4 a share in cash, you can underwrite $3 a share for 2 weeks on a $300 stock and make 10%. Like, doesn't strike me as a bad idea.
If you're that far out of the money, do you even have much gamma in those? You got no delta.
So I don't think so.
What do you even have?
30 cents a premium.
Vol. You must have a lot of vol risk. That's what you got.
Must be the vol risk. I mean, really, it must be the vol risk. But I don't know why.
Right, because that's the only Greek that can move, I would think, because you're so far out of the money. I was thinking in my head, maybe you're trying to do like a reverse gamma squeeze or something, but I don't even think there's enough gamma there.
You're talking about the person buying them.
Yeah, that's right. Yeah.
Why is somebody buying them there?
Yeah, right. You got to be like getting longer vol.
Well, you just like the person buying them is like, you know what, this thing could be a donut, and these things are going to pay off like massively if I can get. I don't know. It's not a very good argument. But
Yeah.
I want my $3 back.
Yeah.
Like a 10 bag if this thing goes to zero.
So think of me like, so I wrote those puts on Curate for 235 in premium, right? Right now on the screen, there is no bid and the offer is 25 cents. If I want to unwind them, I can unwind them for 25 cents right now. And I would take, right, my account has some margin capacity that's been taken out as a result of these calls.
Yeah, you're freeing up capital.
I could buy my way out of that for 25 cents, and I already made a ton of money. So what do I care? So and that could have been the strategy. The guy in the put is like, look, I'll just go ahead and sell these back to you, and then I can just free up my account from that, and I've got a gain, so it doesn't really matter. I'm happy to give it up. For me, I don't want to give it up. So right now it's short term and it's going to expire worthless. So what do I care? And I don't go on margin anyway. But I could see a scenario where somebody's already made so much money that they come in and buy a security where to you it doesn't make sense, but to them it's freeing up capital to something else.
Good answer.
Go longer on the super out of the money calls on the other direction.
I like doing this I like selling puts about a quarter out. So you got about a quarter to run, and then trying to get about 40 to 45% internal rate of return on them, which ends up being about 10% return on them. Because I think that there's this, the quarter that you're in right now is always pretty heavily traded. And then there are people looking at leaps, and there are people looking at to year end, and there are all of these points where people are looking. But the next quarter I've found is often a good one for pricing for whatever reason.
When would you roll
a little bit. Well,
or do you just let them expire?
I'm just looking at them like, this is a special situation that I can take advantage of. And then the opportunity set will change when it comes to the next quarter. It'll be a different set of stocks and a different strike on the options. I don't plan on systematically staying in the same position for an extended period of time.
Then you layer on like a value screen on top of that.
I start with the value screen.
Yeah.
So I'm only looking at stuff that's undervalued. I'm only looking at stuff that's got no volatility in it. That's for the leaps. Well, for the puts, it's the other way around. It's like they're already undervalued. There's a price at which I'll buy them, and then I'll write my puts. So it makes sense given the premium that I get and where I see the value in a worst case scenario. So you can, and then on top of that, you got to get the decent return, enough IRR.
Only thing that sucks about that is sometimes you win by the stock ripping, but you don't have enough delta exposure to that, right? So like you're almost like it's kind of cash inefficient. I like that strategy, but
it's just
that's sort of how you lose in that one,
It's the stock's not quite cheap enough for me to buy it there, but I can see there's a lot of vol, and I can see it if it got down to this price, and I'm not.
Then you'd be fine.
And I just want to get paid at that point for like figured out it's cheap, I've figured out it's got vol in it. I can get paid if it falls to the price where I want to buy it, then I've been paid to buy it there, and that's great. If it doesn't, then I've done something.
Presumably you have cash in this scenario, right? Because you don't want to like sell something about it.
I would never do it
Maybe
naked.
It works. Yeah.
Gotta be cash covered. Yeah.
It's always cash covered.
Yeah.
And it's always size to the notional, so it makes sense for my portfolio. I'm not doing any of that stuff now. I've got other things that I run that I don't do that. But before I had those things that I was running, I did do that a lot.
Do you remember the night we met? Do you remember what we talked about? It was very impactful to me. You obviously meant more to me than I meant to you. But
I drank more than you had.
We basically just crushed wine on a roof and talked about option strategies for a long time.
Oh, good. That's good. That's good.
Yeah.
Probably something that should be stated is anybody listening who does not have a lot of experience with options, if you're going to sell puts, understand the big risk that you're taking is that there is a liquidity crunch and that the market just vomits and it's an opportunity cost. You have to buy the security that you promised to buy. And there might be 50 other securities you'd rather own, but you can't because your money's tied up because you wrote those puts. So
also, don't trade options.
Yeah,
like, for
just
real.
don't trade. You know what? Even better.
Degenerate gambler shit. Don't do it.
Don't do it.
If you're selling puts, you're taking equity downside risk.
Correct.
And you're probably not getting paid enough to do it. But if you have a view about the valuation and there's a point at which you would like to buy it and you want to force yourself to buy it at that point in time because you're worried that you're going to be behaviorally, you might panic or something at the time, this is a way to force yourself to buy it.
Ironically, the best time to sell puts was like March and April of 2020. Like that was the time that you could, because you were almost guaranteed to get the premium. The problem was I did that.
You should have been buying them.
That's right. That's exactly the problem. So the best time to do it is actually the time you should just be getting long the stock, because I would have made a lot more money if I would have just turned around and bought compounds.
That's true.
I do like the idea of buying leaps like here, right? Where you're just like, all right, whatever. I got 2 years. If something, gets burned. The other alternative that Jason Buck said to me is you buy out of the money front month puts all the time. And, you're going to burn like consistently whatever the number is that you want to burn. But when you hit, you're going to hit it big and get cash.
Is that the SPY hedging game that
I think like he and Corey are kind of into that. Does Spitznagel?
Spitznagel has a paper. It used to sit on his site where it's written by one of his analysts, where he describes a strategy of rolling these ladders of puts. And he says that, and you've got to, none of these strategies make sense without some long pairing to something else. The idea is that you're hedging a book, but the payoff is, this is Chris Cole's not Chris Cole's strategy, but Chris Cole's overarching philosophy. And he uses the analogy of the worm rebounding. If you got the worm in there rebounding and feeding it back to MJ, who's taking a whole lot of shots. Yeah.
Dennis Rodman. Yeah.
Rodman's rebounding and giving it back to MJ, who's scoring lots of points, but without Rodman getting as many rebounds as he does, you don't. So he's in that scenario. Cole is rebounding and he's feeding it back to your long strategy to get longer at the right time, and that adds some additional return to your profile, and it cuts off your drawdown, so your return profile looks much better.
JT, what do you think of this thought? The reason I kind of like this thought is like, a lot of us like worship Muffet
Bunga.
yeah, the buff dog and the mung machine, and like. But the thing is, they were always doing that via float, right? They weren't actually selling puts. It was sort of a different mechanism. But ensuring that you have some cash in a true drawdown is something that's intriguing to me. And the idea of cash drag gets less attractive the longer I do this.
Then you don't want to hold cash. Sorry, JT. JT was just about to say something funny.
No, I don't. I mean, you know me. I don't. I try not to overcomplicate it and get too cute and try to over optimize. And instead, what I'm trying to optimize for is my own psychology, and just having the cash makes me more patient to be ready to make the moves. Like I'm not going to miss it because I'm stuck in some put situation that I was trying to squeeze out some extra premium along the way. And then I missed the like really big important move that because I'm stuck there. So because you just never know what the market's going to offer up to you either, and when you're going to want that liquidity. So the optionality,
if you're long puts, what I'm saying is that when that occurs, you're bringing the cash in. That's more the scenario that I was thinking of.
Yeah, I mean, I understand that tail risk insurance idea and the feeding it back into you. And I like, in theory, it sounds great. Right. And, well, I mean, Toby, you and I've had a little bit of experience with a VIX strategy of call options there, which was the same idea. Right. And basically just bled premiums for months on end. And
years in my instance.
Didn't have there was no fire that, gave us the payday to make up for all of that insurance that we bought. So I don't know, like the more I'm in this, the longer that I'm in this, the more I just want to try to keep it as simple as I can and make it easier moves and, take off the reduce complexity.
Where were you guys buying VIX calls? Like north of what, 40?
No, there's a formula for it. It's like a standard deviation outside of where it's trading, but it's always complicated because you got VIX at one level and you've got the VIX futures at another level, and the options are at another level because they have options on the futures. So it's
so at one point you could get this was when like VIX was in single digits, right? Like it was insane. But you could get a $25 or 25, it's not really dollars, but
VIX.
unit strike price for like 5 cents.
Yeah.
And I mean, you just had incredible gearing on it. If it was to have a severe, like, 2008 or even I guess 2020 style just meltdown and VIX jumping to 80 or whatever, like you were going to get paid a lot.
Yeah.
And I thought it was always kind of structurally mispriced because like it has to be in a minimum of 5 cents for it, I think.
Yeah.
And so like there was a weird structural thing in that market where it was like it just sold for 5 cents, but like that wasn't really a price that necessarily made more sense than something else. So I don't know. It didn't feel stupid at the time.
Yeah, the tough thing about that strategy is you've got to be mentally comfortable with the bleed, right? You've got to be okay bleeding premium over and over and over and over and over again. Then someday you're, in theory, should hit it out of the park. Right. Then you just got to notice sell and reverse at the right time.
You need to be long enough on the long side of your book needs to be giving you enough income, through dividends or whatever, that you kind of don't really notice that you're burning that premium all the time.
How do you guys think about insurance for your life, for getting your portfolio? Do you guys have disability insurance? Do you have life insurance? Would you consider yourself to be overinsured? I sort of wonder, my philosophy is the same in both. I'm just sort of wondering if you have different philosophies and how you think about insurance for yourself and your family versus
term life, cheapest shit I can get. But enough disability? That if I die, my wife can, bury me and be okay.
I don't have disability
as well now.
Disabilities, it's pricey.
Already disabled.
Yeah, mentally for sure.
Can't get it. Don't qualify.
Hey, fellas, that's
pre-existing condition.
That's time. We've made it.
All right, I got asked a question on Twitter that somebody wanted me to address it. Crisco, I'll get to it. It's a Formula One question. We'll get to it next week. I'll do it next week.
Sounds good. Same crew next week, I think. Or we've got to force them again. Thanks,
and
fellas.
I think Mike gets relieved.
A lot of sword fighting.
Yeah.